The bear market in the Dow Jones index has just ended. You heard that correct. The Dow Jones index has just entered a bull market after Jerome Powell's comments on Wednesday reinforced the idea that interest rates will indeed be cut very, very soon. Now, if you've been watching my channel for the past couple of months, you already know that I've been indicating about inflation already coming down in the underlying economy, with CPI lagging what the Fed's actually doing. And guess what? Not only did last month's CPI come in below expectations, but this month's core PCE also reinforced the fact that the Fed is on a path to pivot sooner than most investors are pricing in right now. And this is going to potentially result in the S&P 500 entering a new bull market by the start of 2023. And well, that topic is exactly what I'm going to address in this video. But as usual, guys, before you get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So what exactly caused the S&P 500 to end its 3-day losing streak, and what is the underlying inflation data actually showing us? Well, as you already know, Jerome Powell came out with a speech and said that they expect to moderate the pace of interest rate hikes in December and in 2023 because they understand that their efforts work with a lag on the actual economy. And like we have already discussed countless times, the stock market is a forward-looking indicator that tends to run around 6 months ahead of earnings. And as a result, the market is pricing in the fact that interest rate cuts today will reflect in earnings growth and relaxations in 2023. And that same concept is the exact reason why the S&P 500 started tanking in November of 2021, when interest rates were actually only hiked in March of 2022. And I'm already starting to see so many people in disbelief that this rally is just another bear market rally. And although there are chances of that happening if inflation gets worse, the idea is that you will never know which rally will actually take us out of this bear market. And so, like I've said countless times, your job as an investor is just to buy the dip in your highest conviction plays and dollar cost average regardless of what the market does. Because in the long term, macroeconomics have zero effect on the fundamentals of most good businesses. However, because interest rates do affect the ability for most businesses to survive and raise cash, it's important to understand how the stock market correlates with what's happening in the economy. And well, as you can see, over the past 100 years, we've been able to collect enough data to understand that exact correlation. And as you can clearly see, according to Fidelity, there's around a 6-month lag between the bottom of earnings and the bottom of the stock market. And that typically correlates with a PE ratio highlighted in yellow. And this right here is exactly what most retail investors simply don't understand. If they see that there's bad news out there and the stock market actually goes up, they fail to realize the fact that the stock market is forward-looking and it's always going to try to price in what's going to happen in the next 6 months. And so it's not going to be very difficult for me to make this prediction, but I expect most earnings reports for most companies in the S&P 500 or the Nasdaq to actually be pretty bad in 2023. But that does not mean that the stock market cannot go up. Even during the 1970s and 80s, when inflation was extremely high, just like we're seeing right now, earnings always bottomed way after stocks bottomed. As you can see, earnings did not flip towards the positive side until around September of 1975, but the stock market bottomed around September of 1974. And as you can clearly see, even though the earnings trend did not go up too much from 1976 to 1986, the stock market did return well over 50 to 60%. And this is exactly why I don't trust any of the analysts and any of these big firms that predict that 2023 is going to be this massive recessionary year for earnings, and that means that stocks are going to underperform. Because guess what? It's these guys' job to stir you the pot and give you all this poor information so that they can buy the dip in their favorite companies and then make money in the next bull run. And it's also their job to show you data like this that's supposed to scare you and think that the market is going to crash just like 2008, when we have not had a 50% decline in earnings and we have not had a real estate bubble pop. And in reality, we're not even in a technical recession right now, unlike in 2008, which is obviously when the market started crashing. So the key takeaway here is that right now in 2022, the market is pricing in stuff way ahead of time. In 2022, in January, we didn't even have a recession, and we didn't even have interest rate hikes just yet, but the market was already down around 10 to 15% from its all-time highs. In 2008, that was a different crisis because back then the market was going down based on actual economic information and real estate bubbles popping in local areas in America. That caused many foreclosures and many people to default on their mortgages, which obviously would lead to earnings declines for companies. But here in 2022, the story is completely different. The stock market's been going down artificially based on something the Fed is telling us they're going to do within the next 6 months. So whatever the Fed tells us is what the market's going to price in, and they're going to price that in way ahead of time, which is exactly why stocks skyrocketed this week. And guess what? It was never obvious during all these bear market troughs that it was a good time to buy. Price to sales ratio for the S&P 500 has collapsed from $3 to $2.30, and that is around the level of 1999 and 2015. Now think about all the growth that has happened during that 20-year time span and try to understand where software valuations have really brought the index. And guess what? Even if you think the inflation story is what's going to drive the stock market in 2023, try to understand the fact that as oil prices went up in 2022, we saw a record amount of new rigs come online. And that has already resulted in crude oil future prices to collapse since their peak in June. And that has not yet been reflected in the energy sector prices on the S&P 500. So there's a massive chance that Wall Street is still not understanding the full effects of deflation that are currently taking place. And with the annual core PCE inflation data already coming in as expected, which is obviously what the Fed really cares about, we're already starting to see the makings of the next Fed pivot coming soon. And as we all know, the market is most likely going to absolutely love that. Fed fund futures are already expecting us to hit a terminal rate of around 4.94%, with them cutting in 2023 during the summer, which is obviously well expected and well within that 9 to 6 month time frame. And when interest rates start getting cut, valuations for stocks can start going up and certainty for investors starts increasing, which is exactly the recipe you need for a catalyst in the next bull market. But obviously, guys, things can change in the short term, so make sure to do your due diligence before buying and investing in any stocks, and let me know your thoughts down in the comment section below.